For the benefit of our viewers, uh, tell something about SIFs.
Specialized investment fund is a vehicle which gives you all the benefit of mutual fund, like transparency, ease of operation, smaller ticket size, though it is.
What was the thought process of SEBI when they created this category?
SEBI was very clear. The reason why SEBI is pushing SIF, or SEBI pushed SIF so aggressively in the initial phase, because there were multiple problems which needed a solution. First, as I mentioned,
There are many who say, "Oh, we should wait and watch because the new category developing. We have to see." There are some people say, "Oh, we should try to have a first mover advantage. We should get in now to get when you invest at a time when not many people understand it." So, according to you, what type of investors should actually start looking at SIF as a product?
SIF as a product is new, but the fund manager who are managing this have it.
And one final one: mutual fund or SIF?
It's never you can say either and or. It is always both of them. So like earlier we used to have core portfolio and satellite portfolio. Today I think mutual fund as of now should be.
Hello and welcome to Ventura Spotlight, a podcast series that brings you thoughtful conversations with the mind shaping India's investment landscape, exploring their philosophies, experiences, and the lessons they've gathered along the way. In this episode, we are pleased to have with us Mr. Bhavesh Jain, co-head factor investing at Edelweiss Mutual Fund. Bhavesh holds a master's degree in management studies from NL Dalmia Institute, Mumbai, and brings over 16 years of experience in financial markets. He currently manages Edelweiss' suite of smart beta and factor-based strategies, along with a few hybrid and equity schemes which have a combined AUM of over 55,000 crores. In today's conversation, we will explore the evolving idea of specialized investment funds and dive deeper into SIFs. The total AUM of the industry is now at 6,000 crores, and Altiva's AUM is around more than 2,300 crores, which is managed by Bhavesh and his team. So let's get started. Hello, Bhavesh, and welcome to Ventura Spotlight. And thank you, first of all, for being with us on this show. Uh, so, before we dig in more into the details, can you tell us how you started into this investment journey and what attracted you towards factor-based investing?
Yep. Thanks for giving us this opportunity. I think Ventura team is doing a great work to have this session. If you ask me, I directly joined Edelweiss from my campus. So this is my first job. And the reason why I choose Edelweiss during my campus days was because finance was something which was anyways my, you can say, core area, my specialty, my thought process was always in numbers. So I thought finance definitely is the first field I have to go. Within that, I think capital market or stock market is something where you will see actually a lot of activities, whether it is economics, whether it is human behavior, whether it is news flow, and that is how you get attracted to this thing. So that is how I thought that I have to be in stock market. Now within that, after years of, you can say, initial experience when I joined Edelweiss Prop, and then initial days where I was working in Edelweiss Mutual Fund as an equity dealer, that is where I realized that stock specific activity, if you are a specialist in picking one stock or picking one sector, there is a limitation to it. You can outperform for one cycle and then you will underperform. But that is where I realized that it is more about process rather than person. And that is where I got attracted to factor investing. I thought that discipline of selecting stock is much more important rather than, you can say, being a specialist in a particular sector and then try to select good stocks in those sectors. So once I got this comfort that if we are following a disciplined process, I think factor investing is the closest thing which helps you to take out all your emotions out of this decision making process. You can always be following, you can say, a rational approach towards selecting factors rather than selecting stocks. So it is very difficult to predict what this stock will do, but it is very easy to predict that what are the characteristic which has always separated and a good performing stock with a bad performing stock. And that is where my journey in factor investing started. I think we are one of the oldest in the industry to do factor investing for last almost 13, 14 years now. And the growth is there in front of you to see. So it has worked very well for us, worked very well for our organization, and I'm sure it worked very well for all our investors also.
So I like the the statement you made, process over the person, because I
Yes.
think a person is actually driven more by emotions at time,
Yes.
and the process will at least ensure that he is right on track. Right?
Yeah.
So a very interesting thought process. So when did this change happen for you?
So I think this was somewhere in 2013, and before that, as I joined in 2008, obviously the start itself was very painful, and then as we moved 2008, 2011, and 2013, these were three tough years for market, I can say, and that is where I got the clarity that all your fundamentals or all your, so nothing against any style of investment, but all your fundamentals, all your you can say conviction can go for a toss if markets is seeing such kind of event, whether it was global financial crisis or it was 2011 European crisis and 2013 taper tantrum. So that you can say in a way gave me much you can say stronger conviction that all your process, if you don't follow process, all your conviction will not stay with you. And that is where I thought discipline investment without emotional you can say attachment to a particular stock or a particular sector is something which will help you in the long run. If you would have been in market because we just started our career in 2008 global financial crisis, you will know how difficult it was to continue with your SIP, to continue with your stock selection, to continue with your equity holding. A lot of wrong decisions were made when you became emotional. If you would have followed your asset allocation, if you would have followed factor based approach on selecting good stock on the basis of characteristic, you would have made a lot of money, and at least you would have protected a lot of damage to your portfolio. So this you can say situation of crisis actually made my conviction very stronger to move towards factor investing.
Okay. So, since you said that, you can also control the damage, and, and that is one of the reason where now we have a completely new category, specialized investment funds. And, and there's a lot of talk which is
Yeah.
happening around that. And, Edelweiss has also taken a lead in terms of doing the SIFs. So, can you, for the benefit of our viewers, uh, tell something about SIFs and what it is and how one should look at it.
Sure. So I think see there are multiple vehicles through which investor can invest money in public domain, at least in public markets. So earlier the investment vehicles were mutual fund, AIF and PMS. So mutual fund have history of more than 30 years. AIF, PMS again history of more than 20, 30 years. But there was a huge gap. See, a retail investor who is starting with smaller SIP, 1,000, 2,000, 5,000, 10,000, if he have to upgrade himself as a PMS investor or as an AIF investor, the entry barrier was very huge. You have to start with 50 lakhs or 1 crore. So that gap was huge. So that is where I think SIF becomes very important. So specialized investment fund is a vehicle which gives you all the benefit of mutual fund, like transparency, ease of operation, smaller ticket size. Though it is 10 lakhs compared to you can say 1,000, 5,000 in mutual fund, it is slightly higher. But that is an aspirational number, which I think more and more people are now in a position. Those who are in markets for last 5, 10 years would have accumulated a wealth at a portfolio level at that they can invest 10 lakh in one SIF. So one SIF can have 7 different products. That is another discussion we can have. But I think this will be an upgrade for them. Rather than putting 50 lakhs or 1 crore in single scheme, they can put 10 lakh rupees across multiple schemes of SIF. Now, the interesting part of SIF, as I said, ease of operation, transparency, and taxation, the most important part of mutual fund is applicable. At the same time, flexibility of an AIF and PMS is now being given to a mutual fund investor also. So, like one of the feature was mutual fund by designs are long only. Now in SIF, it can be long short. So you can do some short trading also. So in mutual fund, things are becoming more and more commoditized. So if it is a large cap fund, 80% in same 100 stock. If it is a mid cap fund, 65% in same 150 stocks. So fund manager had a very limited, you can say, scope of deviating his portfolio and trying to outperform others in the industry. So this SIF will give fund managers huge amount of flexibility, and that is where you will see incremental outperformance in SIF compared to the same strategy on a mutual fund platform or an AIF platform will be much easier because it is getting best of both of the worlds, whether it is, as I said, all the benefits of mutual fund as well as flexibility of AIF. So this will be something very big in next few years. Definitely very big.
So very interesting, and in fact, it is. I'm also just getting to know some things more about it. That it's a combination of a PMS, an AIF, and a mutual fund. So you get the benefits of the taxation of a mutual fund.
Yes.
You get the flexibility of investing in stocks like a PMS, and you get the benefit to even shorting like an AIF. Right?
Yes.
What was the thought process of SEBI when they created this category? Is there any other insights which are there apart from
Sure,
what
sure.
is there in the public domain?
So I think, SEBI was very clear. The reason why SEBI is pushing SIF, or SEBI pushed SIF so aggressively in the initial phase, because there were multiple problems which needed a solution. First, as I mentioned, huge gap in entry level. So a mutual fund, one can start with 1,000, 2,000, 5,000, but PMS and AIF was at 50 lakhs and 1 crore. So huge gap over there. Second, there was a constant ask from the industry itself that mutual fund is now becoming a very tightly regulated entity. Even if I am, say for example, if I am negative on a particular stock, or I am particular on a particular sector, or overall on market, in mutual fund at best I can take a cash call, and that too I have a limitation, because again, if you see from taxation point of view, minimum 65% should be there. In some categories like thematic fund and etc., 80% always have to be in theme. So very tightly regulated country, you can say product. So even if I am negative on a particular stock or a negative on a particular sector, at best I could avoid those stocks and avoid those sectors and protect my downside, but I would not be in a position to make profit out of that. So now you have given us that flexibility that if you are negative, you can take a negative view also. You can express your negative view by taking a short position also. Third, I think the biggest challenge was where, if you will see, SEBI was continuously publishing a data which shows that more than 90% of retail investor was losing money in derivative trading. And that loss was as high as 1 lakh crore. Now, for an Indian retail and HNI investor, derivative trading has become, you can say, something which the volume which keeps on going higher and higher month after month, year after year. SEBI took multiple steps. Right now, again, you will see in budget also government increased STT to reduce some of the derivative turnover. Before that, SEBI reduced number of weekly expiry. So almost every day there was an expiry. They cut it down. Now only Nifty and Sensex have weekly expiry. They increased lot size from 5 lakh, 10 lakhs to almost 20 lakhs. But still, the retail frenzy in derivative is not ready to stop. In that same process, this was another step that at least if some part of those investors move into SIF, where you will get your urge or your itch to trade in derivative will be satisfied, but through a professional managing it, a professional fund manager managing it, so that probability of incurring losses can go down to some extent. Right now, more than 90% of the people are losing 1 lakh crore. So at least some portion of that losses can be prevented if they move into SIF. So that is one more thought process beyond, you can say, launching SIF from regulator.
And so since you mentioned regarding this 90% category of retail investors losing money, and which is in fact a reality, and I think now SEBI is also publishing that entire study.
Yeah.
And because of that, the budget also has made a increase in the STT. And since you will also be shorting, I mean, you are doing shorting in a much more defined manner and at a much more portfolio level, etc. Does this increase in STT, will it have any impact on the returns, which will be substantial, or it is a very minuscule?
So I think,
aspect?
see, the I managed across Edelweiss, so I manage multiple funds. The most important fund where STD will have an impact will be arbitrage fund, because that is 100% derivative portfolio. So we have 65%, 70% equity, and against that we sell 70% stock future. So over there, every month we roll over our position. So our cost is going up by 3 basis points from 2 to 5. So 3 basis point per month into 12 months. So annualized cost will be almost 36 basis point. And this will be on 70% of my portfolio, because remaining 30 is in debt. So 36 basis point on 70% of my portfolio, roughly 22, 23 basis point is the impact. Now, a part of this impact I will pass on to the counterparty, because if my cost of rollover is going up, obviously my roll levels or my ask to roll will also go up. So a part of that can be passed on to the counterparty, but yes, it will still have an impact of 10 to 15 basis point. But the maths over there is very simple. Earlier so if you compare, say for example, liquid fund and arbitrage fund, because arbitrage is just a proxy to liquid fund. If both of us are giving 7% return, earlier the advantage what we had over a liquid fund on a post-tax basis was almost 120 basis point. Now that advantage will come down to say 95 to 100 basis point. But still that 100 basis point is a huge number. And till the time this alpha over and above liquid fund is there, you will keep on seeing flows coming into arbitrage fund. Beyond arbitrage fund, there will be impact on other funds where we use derivative, whether it is Altiva, our SIF, or whether it is balance advantage fund, whether it is our equity saving fund. But because derivative will be 35-40% of all this portfolio, the impact will be less than 10 basis points. So much lower compared to what it will be on an arbitrage fund.
Okay. So very minuscule impact.
Yes, 10 to 20 basis point across category, you can say.
Correct. Okay. Yeah. Nice. So you also mentioned that there are different categories in the SIF module. I think there are 7 categories which are there.
Yes.
So can you share some light on that? Because the more and which are the more popular ones?
Sure. So see, first it is very important to understand that SIF is just like mutual fund. So in mutual fund also you have equity fund, you have debt fund, you have hybrid fund. Similarly in SIF also you will have equity SIF, you will have fixed income SIF, and you will have hybrid SIF. So equity SIF, like equity mutual fund, will have equity taxation because your equity will always be more than 65%. So within equity, there are 3 categories now. So like you have large cap, mid cap, small cap funds. Here also you will have different categories of product. So the first one is equity long short. So first, the important feature, all 7 categories are known as long short fund. Now because they are long short fund, they cannot be part of your traditional long only mutual fund brand name. So like Edelweiss Mutual Fund will have all long only products. Because SIF have long short, it will not be part of Edelweiss Mutual Fund. The regulator has asked us to create a separate brand name. Like Altiva is a separate brand name for us. And all our SIF, because they are long short, will be part of our Altiva brand name and not Edelweiss brand name. So first 5 years, we can still use it, Altiva by Edelweiss Mutual Fund. After that, by Edelweiss Mutual Fund will also not be utilized. Now, Altiva will have 7 different products. So first 3 on the equity side. The first one is equity long short fund. The regulation, as I said, has given a huge amount of flexibility to the fund manager. So the only rule for equity long short fund is minimum 80% should always be in equity. 20% can be equity, 20% can be debt, your choice. But minimum 80% should always be in equity. Today, large cap fund also have similar definition. Minimum 80% should always be in equity. But over there, equity is predefined. When it comes to large cap fund, 80% always have to be in equity, and that equity is top 100 shares by market cap. Here, correct, regulator have asked you 80% have to be in equity, but where you want to put, whether it is large cap, mid cap, small cap, micro cap, arbitrage, long short, full flexibility given to the fund manager. And because there is so much amount of flexibility, it will be very difficult to compare one fund with other. See, within equity long short fund, you can choose to run a large cap fund. I can choose to run an arbitrage fund. Someone else can come and run a micro cap fund. All 3 is allowed. So as I said, flexibility is there, and that's why it is not easy to compare different strategies with different AMCs. What you normally do, you compare 10 large cap fund, 10 mid cap fund, 10 arbitrage fund. This is very difficult in SIF. So first is equity long short. 25% short is allowed in all the 7 category, but that is optional, no compulsion. If you want to use, you can use 55 long and 25 short. So 80% in equity will still be there. But whether you want to use short or not, it is your choice. But because everyone is allowed to use short, all the funds will be known as long short fund. Second is X top 100 long short fund. As the name itself suggests, X top 100, that means it is mid cap and small cap. Now again, you have mid cap fund in mutual fund, you have small cap fund in mutual fund, but the limitation is in mid cap fund, 65% always have to be in 101 to 250, and in small cap fund, 65% always have to be beyond 250. Here, no such restriction. 65% should be out of top 100. Now, out of top 100, whether you want to have 100% mid cap, small cap, micro cap, full freedom given to the fund manager. So just think a mid cap fund manager or a small cap fund manager, he can pick his best mid cap ideas, best small cap ideas, and put it in a single fund. Rather than having 2 separate mid and small cap fund in mutual fund, he will pick best ideas from both of the funds and put it in a single fund. So this is what your X top 100 long short is. Again, the feature of 25% short is available. Third and the most tricky category is your sector rotation fund. Now you have business cycle fund, you have sector rotation fund in mutual fund also, but there is no restriction that how many sectors you can buy or keep in your portfolio. In SIF, in business cycle fund or in sector rotation fund, the rule is at any point of time, you cannot have more than 4 sectors in your portfolio. Now, whether you are long or short, total number of sectors cannot be more than 4. And the biggest challenge is within a sector, you cannot do long short. So 4 sectors, 100% exposure. So you can assume that we are going to take a very aggressive sectoral call, and particularly if you are going to take a short position. So short and long put together, sectors have to be 4.
Okay.
So even if you take 25% short position in a particular sector, which I think is a very difficult call to take, remaining 3 sectors have to be almost, you can say 75-80% in long side. Other than banking, today no sector have more than 25% weightage in index. So any sector you decide, you have to take a big overweight call. And that's why it will be the tricky strategy. So you can say strategy as of now. So these are 3 equity. All 3 will have equity taxation because, as I said, minimum equity of 65 by default will be there in all the 3. 2 fixed income strategy. As of now, none of the AMC have launched a fixed income SIF because, as I said, taxation of mutual fund is applicable to SIF also. So today the biggest problem in fixed income is taxation.
Correct.
And that is same which is getting carried forward in SIF. That's why we have not seen any interest as of now from any AMC to launch a fixed income SIF. But just for understanding, 2 products available in on the fixed income side. In simple word, one is duration fund and second one is a credit fund. So sectoral fixed income fund is nothing but a credit fund where you can take active call on AAA, AA and single A. Limits, so as I said, flexibility again is given over there also. So today, if you have single issuer limit of say 10% for a AAA rated assets, in SIF that limit from 10 has become 20. For AA from 8, it has become 16. And for single A from 6, it has become 12. So fund managers has got, you can say, a lot of flexibility to run a concentrated portfolio. And second, and the biggest problem of fixed income, what happened in 2008 with 2018 with some of the AMC was your asset liability mismatch. So that's why here they are now allowing you to have redemption cycle, which will be much, you can say, restricted one. So at best, we can give 1 redemption in a week. In mutual fund, you have daily purchase, daily NAV is published, and daily you can redeem. In SIF, in equity also, you have the option daily purchase, daily NAV, and daily redemption. But if an AMC want, we can keep a restricted version. Once in a week, once in a month, once in a quarter, once in a year is also allowed. For debt SIF, at best, you can give redemption once in a week. Even if you want, you cannot give twice, thrice, 4 times in a week.
Okay.
At best, once in a week. Again, if you want a restricted version, once in a month, once in a quarter, once in a year is also allowed. So unlike what happened in 2018, here you can manage your liquidity because your redemption cycle can be in your control. Third is the hybrid category. I think this is the most popular category also. Within hybrid, there are 2 categories. One is multi-asset allocation fund, which is active asset allocator. And the second one is your hybrid long short fund, which we have launched. Now, actually, asset allocator again is like your multi-asset fund. You can have investment in commodities, equity, debt, REITs, InvITs, international securities, everything. And there is no minimum maximum requirement. Like in today in multi-asset, there is a requirement of minimum 10% in 3 asset classes and then 10 to 80 in equity, 10 to 80 in debt and 10 to 30 in commodities. There is no such restriction over here. You can be 0 to 100 in any of the asset class you want. Again, 25% short is allowed into traditional multi-asset fund. It is long only multi-asset fund. Even now, if I am say negative on equity, you have to keep long 10% compulsory over there. Here you can keep 25% short equity also. So you are long gold, long silver, long debt and short equity. That is also allowed. So again, as I said, flexibility is the biggest advantage for all SIF. 7th category or the second category in the hybrid is the most popular category. 7 AMCs which have launched SIF as of now. 6 of them have gone ahead and launched hybrid long short fund. So that clearly shows that this is the most popular category. Now, hybrid long short fund, the reason is 1, it is the most easiest category. Second, today the biggest problem in the market is the fixed income alternative. Hybrid long short fund can solve that problem. And that's why it is, as I said, 6 out of 7 AMCs have launched this product. So the only regulation over here is minimum 25% should always be in equity. Minimum 25% should always be in debt. Remaining 50% fund managers are free to choose where they want to put. So again, just to give context, 4 older, when I say older, couple of them just completed their NFO in last, you can say 10-15 days. But before that, 4 AMCs have completed more than 1 month. So you will see in mutual fund, there were 4 different categories. Arbitrage fund, equity saving fund, balance advantage fund, and your aggressive hybrid fund. In SIF, 4 AMCs which have launched hybrid long short fund and have completed more than 1 month. So Altiva by us was like an arbitrage plus strategy. We are very much closer to an arbitrage fund. One of them is equity saving fund, one of them is balance advantage fund, and one of them is aggressive hybrid fund. That's why I said flexibility is the biggest advantage, at the same time biggest disadvantage also, because now a layman who is comparing all hybrid long short fund,
Yes.
he will see one fund has delivered 11% annualized and other fund has delivered negative 2% annualized. So why so much of deviation? Because strategy itself are totally different. In mutual fund, you don't compare arbitrage fund with balance advantage fund or aggressive hybrid fund with equity saving fund. But here, because all of us are known as hybrid long short fund, this comparison will keep on happening. And that's why it is very important for all your client and all your investor to study strategy by strategy rather than just looking at the name of the product.
No. I think, Bhavesh, it was a absolutely insightful summary. I think this is really going to be a very interesting session. I think for most of the investors to, just understand everything. I think you have nailed it. That is all what I can say. And it is so interesting that now, in fact, the role of even the advisors and distributors will also become much, much more, because I think the biggest challenge is going to be that you cannot compare one single product.
Yes.
Right? Because each one will have a different strategy, right? And that's what we have been seeing, and and it also gives a lot of flexibility to the investor and even to the fund manager. So now basically large cap is gone, mid cap is gone, small cap. You can define where you want to invest. So mid and small cap can become one part of the product, and you can go in short. Even the sectoral one is very interesting, that where you cannot short a particular sector and be long at the same time.
Yes. So you cannot take a contra trade.
Yeah,
That
you
is the
cannot
most important challenge we will face.
Correct. So I think that was in fact even an insight for us also, that we also ourselves did not know. I just have one question specifically on the fixed income side. I know it's very, I don't even know how much of the funds will come into that category because of the taxation disadvantage. But over there, how the shorting will happen, because we do have interest rate
So I think
futures.
right now you will see that is the reason why we are not seeing any interest or anyone keen to launch this product as of now, because derivative market on fixed income side is very shallow. We have not
Correct.
seen a lot of players actively doing volumes over there, actively doing trading over there. So interest rate swaps, OIS, there are instrument, but I don't think a lot of fixed income fund managers also have ever tested that. So in derivative of the equity side, again, we are facing similar challenge. Finding right talent who can do derivative trading, particularly on the short side, even on equity is a challenge.
Right.
Then just imagine how difficult it will be for a fixed income fund manager. So right talent is something which is missing. Right volume, that also will be a challenge on the fixed income side. So still, as I said, still early days, and everyone, including you can say regulator, whether it is RBI, whether it is SEBI, and a lot of you can say industry bodies also are in constant discussion that how we tackle this problem and try to find out and you can say something which will help fixed income industry to grow, because after 2023 taxation change, the category is not even growing by the mark to market amount what they should have gone up. We are not even seeing that. So net redemption is still there. And on the other hand, I think there are a lot of other products which are becoming popular, which are in a way trying to solve your fixed income need. So arbitrage fund you will see where at 80,000 crore in 2023 are already at 3,20,000 crore of AUM. So our own arbitrage fund in last, you can say, we started with 58 crore in NFO and today we are at 16,000 crore. So that is the kind of we have seen. The whole problem of fixed income in a way is helping other products, particularly hybrid products, to grow. But very early days, as I said, on the fixed income derivative piece. Right now, I think fixed income problem will be solved through, you can say, some of the better credit flexibility given and some of the better liquidity redemption flexibility given. That too will be the biggest advantage rather than on the derivative front. See, the reason why equity derivative works, because people will always have contra view. I am doing arbitrage, someone is doing speculation, and we can have this contra view, and that's why we can have volume. In fixed income, 90% of people will have same view. So from where you will get counterparty?
Right.
See, it's our view in a way is navigated by RBI thought process. So if RBI is bullish, RBI is, you can say, in a hawk mode or in a dovish mode, accordingly, everyone's view will change. So if
Correct.
all of us have similar view, how you will get a derivative market? Because you always want a counterparty who is ready to take that opposite position. So that will be a challenge for fixed income investor.
Yeah, I think that is a very, very interesting point, in
Yes.
terms of because on various stocks in the equity side, you'll always have a contra view.
Yes.
I mean, one person is buying, the other guy is selling. But over here, specifically when you know that interest rate is going to go down, I mean, majority of them have the
90% people will have same view because
view.
see, finally, as I said, your view and my view hardly matters. It is finally what is the statement of RBI after that MPC
Correct.
meeting.
Correct.
That where we are on the, you can say that entire horizon, whether we are dovish, whether we are hawkish, whether we are neutral, accommodative, and accordingly you can change your view depending on that one statement.
So Bhavesh, now having understood the products, and so we focus more on the equity and the hybrid, because debt is not going to be on the investors' purview as of now, right? So according to you, how should investors view at this product? Specifically now, there are many who say, "Oh, we should wait and watch because there's a new category developing. We have to see." There's some people say, "Oh, we should try to have a first mover advantage. We should get in now to get when you invest at a time when not many people understand it." So, according to you, what type of investors should actually start looking at SIF as a product?
So I think, see, the way we look at it, though SIF as a product is new, but the fund manager who are managing this have a track record, proven track record of last many, many years. And most of the AMCs are doing that same. They are bringing experienced fund manager to manage that. Now, sometime your large cap fund also launched for the first time. Someone would have launched the mid cap fund also first time. Similarly, someone is launching X top 100 for the first time. Someone is launching hybrid long short for the first time. For you, the important thing is to understand the thought process behind the strategy, what a particular AMC is launching. As I said, large cap fund, you take 10 large cap fund, all of will have 80% in same 100 stock. But in this, as I said, each of this hybrid long short SIF are totally different from each other. So you have to understand your risk return profile. You have to understand what is your requirement. And out of all this available product, which is the closest one which can solve your problem. Not necessarily that everyone have to invest in SIF. Not necessarily that everyone have to wait and watch and have a track record of 1 year, 2 year, 3 year, and then invest. Because see, today also you see some of the AMCs are just coming up today. So like we have seen some of the large conglomerate launching, you can say AMCs in the last 3 years. So they are also launching flexi cap fund for the first time. But flexi cap as a product have a track record, and you know that what is the fund manager's bandwidth within that product. So if you are comfortable with flexi cap as an idea, you know that this fund manager previously has worked within those so and so organization, and it has been his track record. So you have to trust the fund managers over there, and then you have to select the category. Here the challenge is most of the fund managers are doing derivative for the first time, and that's why we say that at least take 3 month time to evaluate any strategy. Otherwise, if you do a normal large cap fund, a normal mid cap fund, you go into NFO also. Here we are saying go slow. You evaluate the performance, try to understand the strategy, because once you look at the strategy and the performance for 3 months, 6 months, 1 year, only then you will realize that whatever have been communicated during NFO or during initial meeting, the same whether it is visible in the numbers, in the performance, in the monthly portfolio or not. Unlike in, you can say AIF or PMS, where normally we say wait for 1 year, 2 year, 3 year, because this is a mutual fund replica, you get monthly fact sheet, you get daily NAV. I think 3 month data is good enough or 6 month data is good enough to take your decision. But those who are nuanced investor, those who are comfortable with derivative trading, for them there is no harm to invest on day one itself. Once you add a communication with the AMC or with the fund manager or with the team of that AMC, you understand the risk return profile, and then you can go ahead with that also. So I don't think that this is something totally new. Like our strategy, as I said, is an arbitrage plus strategy. If someone is doing arbitrage for less 10 years, so we are somewhere between arbitrage and then say balance advantage fund, or arbitrage and an equity saving fund. So for them, the risk return profile understanding is much, much easier. So they can start in initial period also. So just to put in numbers again, in our NFO, we got 300 crore. And today as we speak, we have not even completed 4 months. We are already at 2300 crore. So that 8x journey has come because initial investor who came in NFO were believing on us and believing on the concept. And after that, all those who have joined have looked at the number and comfort what we have been able to deliver across market cycle. We have seen good market, bad markets, volatile markets in last 4 months and how consistently we've been able to deliver number. So that is giving a lot of comfort and conviction.
I think one thing which I have understood is that first of all, lot of advisors and distributors will also have to understand each and every product. Right?
Definitely.
So it is not a product which is going to fit everyone. I think in one way it is also good that the minimum size is kept at 10 lakhs, so that brings in a bit of seriousness even from the investor to also
Yes.
understand about the product and not kept that okay, somebody told me so I'll just put in the money over there, right? And I think now every investor will have to start understanding and be satisfied with the returns he's going to get, right?
Yes.
And not try to compare that, array, that large cap fund is giving this much return and I missed out because I was investing in another large cap.
Yes.
So there will be no comparison per se. I think each one will have to be satisfied with what is the risk he is taking and what is the return which he is getting.
And I think finally, investor and distributor both will appreciate that returns are an outcome. You have to follow the process because now, as I said, if you look at returns, you are comparing arbitrage fund with balance advantage fund or arbitrage fund with an equity saving fund or an arbitrage fund with an aggressive hybrid fund. In bull market, arbitrage will look bad, and in a bearish market, by default, it will look good.
Correct.
So that comparison, now returns cannot be compared. You have to look at the process, and the fund which is having a process or a philosophy which is closely matching the client's requirement, you have to select that fund and not only the returns or the numbers which come on the Excel sheet.
Yeah, that's what I'm saying. So now that, otherwise we always used to have that generally the investors will go by the most popular funds, and the popular funds are the top 5 or the top 10 which are performing. And
Winners of last year, I can say.
winners of last year. And so I think a huge change even in the investor mindset. And I think specifically for hybrid and multi-asset, in fact, even today in multi-asset also it becomes very difficult because anybody can have different allocation to equity
100%.
and debt, and here it is going to be much more different.
Yes.
Right,
Because
because
0 to 100.
Yeah,
So
I mean,
that is the challenge anyone will face.
just imagine I can be short on equity and long on gold.
Yes.
Long
both
on
can go
equity,
ag-
short
both
on
can go
gold.
against you.
I mean, so you
Both can go in your favor and both can go against you. That's
Yeah.
why your outcome will be totally different from your peer set.
right.
So that is where you will be able to differentiate. See, as I said, if you just look at returns, you will get much confusion. If you look at the process and you trust the process, only then you should invest.
Nice, yeah. So now we understood that okay, the returns will be an outcome as you mentioned, right? So in your view, what are the risks that an investor should be mindful about when he is investing in SIFs?
Yes. So I think, see, right now, these are still early days. We have just completed 4 months. The industry has completed just 4 months. But within 4 months, something which is now becoming more and more popular or is something, as I said, hybrid long short fund category, because this is the only category where you have multiple funds and you can compare risk return and other parameters. So if I say my strategy is an arbitrage plus strategy, and if I have a standard deviation of 8, 9, 10%, that means what I am saying and what I am doing is not matching. If I am saying that I am running an arbitrage plus strategy, arbitrage fund have standard deviation of 75, 80 basis point. So my standard deviation should be 1.5 to 2.5%. It is fine. Right now, if you will see our strategy is arbitrage plus strategy, our standard deviation is 1.9%. So what we said and what we are delivering are almost matching. Second, I say I'm an arbitrage plus because I don't have a core equity portfolio. I don't have a naked equity portfolio, neither long, neither short. So there you will see my portfolio beta. It is 0.1. So again, matching what I am communicating. So all these parameters will become more and more important. People just cannot look at returns. They have to look at risk parameter, volatility, standard deviation, upside capture, downside capture, and then evaluate whether I want to go into an arbitrage kind of product or an aggressive hybrid kind of product, because both are available. But what is my requirement? Why I am coming to an SIF, I'm not going to a normal aggressive hybrid fund or a normal arbitrage fund. Because if like as I said in hybrid long short fund, the intention what we are trying to deliver is arbitrage plus 3% on a post-fees, post-tax basis. If client is happy with that, then he should not look at in a bull market, aggressive hybrid fund has delivered 18% and I have still delivered 9% because 6 plus 3 is 9. So if I want to beat arbitrage fund, I have to deliver 9% return, 6 plus 3. Then in bull market, there will be fund which will deliver 20%. And in the same bear market, that same fund will deliver negative 10%. I will be in the range of 8 to 10%, whether it is a bull market or a bear market. So that clarity of thought is must in investor as well as the distributor partners also.
Okay, yeah, I think that is very, very important. Right? And now, any particular reason? I mean, you did mention that this is a very interesting category, hybrid, because it combines nearly all the four categories of hybrid. And so what was the thought process behind Altiva to launch hybrid as a category and not equity?
So I think there were 3 or 4 reasons why we choose to launch hybrid long short fund first and not the, you can say, the fancy items, or you can say the one which will be more popular like X top 100 or equity long short. There are 2-3 reasons. First, this is something new, so we wanted to be very conservative, very safe. Second, we wanted to play to our strength. See, as a fund manager managing arbitrage fund, balance advantage fund, equity saving fund, we were much comfortable of using derivative on the hybrid space. And that was our strength, and we had everything in-house. We were not requiring any external hiring for launching this product. So that's why for us, this was definitely a go-to product. Third, when we were launching this product, already for last 1.5 year, equity markets have given you 0 return. So now this is a time where we have to increase risk in equity. We have to increase appetite in equity. We are becoming more constructive on equity, more positive on equity. So at this point of time, if I don't think short will help me. If I am positive on market, short is not going to help me at this point of time. This is a time where we want to push aggressive long products. Once market is in some euphoric zone, some you can say we have seen decent run up. After that, short will become very useful. So right now, anyways, we don't find that there is a great opportunities because valuation wise, we feel markets have seen a decent 18 month of consolidation. We have seen stock specific correction. So though headline Nifty looks like we are at lifetime high, but when you look at NSE 500, more than 300 stocks are down 15 to 20%. So decent price correction, decent time correction has already happened. So we were not finding an urge to launch a long short fund on directional side at that point of time. But now we have seen decent run up. So Nifty when we launched was around 24,500. We have seen already move towards 26,000. Maybe in next couple of months, we will see newer lifetime highs also. And then somewhere in April or May, we will launch our X top 100 long short fund also. Okay. Because again, as I said, we want to play to our strength. So within equity long short and X top 100 long short, our strength is in mid cap and small cap. So Trideep Bhattacharya, our equity CIO, you will see his performance in mid cap and small cap fund. Number 1, number 2, across time frame, you look at short term 1 year, 3 year, 5 year, long term 10 year, 15 year. He has delivered great performance on the mid cap and small cap side. So that again is our strength. So we will launch X top 100, the second product from our end, because by that time we feel that markets have seen some decent recovery. Okay. So long and short will become more and more important. And again, as I said, short is a feature, not a compulsion. So there is no requirement that we always need to have a short trade in our product also. And because, as I said, these are the multiple reasons. This is new, so we wanted to be slow. We wanted to be 100% sure what we communicate and what we deliver matches with each other. And I think in 4 months, we have done a reasonable job. And that's why we have seen almost a 8x growth in our AUM since our NFO.
Okay, so good. So now if an investor has to look at a time horizon so one is the equity long short, what is the ideal duration he should have? Because generally, investors just go by the taxation period as the holding period.
No. Right? So see, today even if you look at a mid cap fund and a small cap fund, taxation period is 1 year.
Correct.
But normally what we say, if you are coming in mid cap and small cap fund, stay invest at least for 3 year, 5 year.
Correct.
And same thing goes over here also.
Correct.
See, each category is not new. It is anyways going to replicate either an existing mutual fund product or an existing PMS product or an existing AIF product. So time horizons are already defined. Like X top 100 is nothing but a mid cap and small cap replacement. So by default, your minimum investment horizon in X top 100 should be 3 to 5 years.
Correct.
Equity long short is nothing but replacement to your flexi cap category, to your large cap category.
Correct.
So again, by default, it is equity oriented strategy. So minimum investment period should be 3 years. Sectoral long short will be a thematic fund. Your holding period minimum should be 5 years. Now, our strategy in hybrid long short is an arbitrage plus. So in arbitrage fund, we say normally wait for 6 months to 12 months. It is an arbitrage plus category.
Correct.
So though our holding period taxation wise after 1 year is 12.5, but we still insist you invest minimum for 18 to 24 months.
Okay.
So depending on which kind of product you are investing, your existing mutual fund have a predefined exit load or predefined minimum holding period for this product. Same has to be replicated over here also.
Okay. So only no, mainly I was more on the hybrid side because everybody will run a different strategy.
Yes.
So like since you are running it as an arbitrage plus, so
Yes.
obviously that period
So
will be
for us,
shorter.
so I think here also I think very important because for us, because we are an arbitrage plus, holding period can be 18 months.
Okay.
Depending on what kind of characteristic the fund have, accordingly
Okay.
you have to decide your holding period.
Okay, fine. That's I think important to understand that, right? Very important. Okay, and so one more question that you have to manage so many funds, right? So what do you do to unwind after a day of complete volatility in the market? I will not call it stressful,
Yeah.
but it will be always volatile.
You see, it is like if I have chosen this field, that means I love that volatility and I'm happy to, I enjoy that volatility. So if you will see, I manage funds starting from basic products like arbitrage fund and index fund and goes to SIF and our business cycle fund and our IPO dedicated fund. So total AUM of almost 55,000 crore. So obviously, very tight schedule, very stressful days sometimes because of market and because of to you can say keep on you can say adding volatility in our life. But I think overall, the good part of our markets are once you go home, you can just enjoy with your family, your kids, your wife, your family, and you can have good time with them, and that itself unwinds you in a much better way. Plus, Saturday, Sundays are yours, so you have this you can say long weekends, you have a lot of public holidays, so you have much time to you can say in a way enjoy your personal life as well as your professional life till the time your performance doesn't hurt you internally at a personal level. You should be able to manage that emotions, then it is fine. If it starts hurting your health, if it starts hurting you personally, then things will not be in your control. Then it's better to quit and look for a different job.
Good. So, it was a very insightful session. So, thanks for that, Bhavesh. So, we will end with a rapid fire. So, we'll just do some rapid fire with you. Okay.
Yep.
One factor that deserves more patience than investors usually give it.
I think earnings growth. See, normally people are more ready to give more time to price growth, but are not ready to give, you can say, enough time for earnings growth. See, one bad quarter because of different reason can always happen. But if fundamentally the company is good, so I think earnings growth is something which should be given much more importance rather than price growth.
Okay. One signal you ignore even when everyone is shouting about it.
I think predicting short term, what will happen in market in 3 months, what will happen if RBI do this. Never try to predict short term because even though everyone is fascinated about that, everyone tries to in a way think that I can predict what will be the outcome of this. We have seen multiple times. Even if your view go right, market can correct on that day because already priced in.
Correct.
So your view can go wrong, and that's why I think it is an futile exercise to predict what will happen in next 1 month, 2 month, 3 month.
One risk that doesn't show up in data but matters deeply.
Human emotions, or you can say behavior, because see, more amount of money has been lost because of behavior rather than actual market movement. So we have seen multiple time people stop their SIP at the worst time, have sold their you can say portfolio at the worst correction, and have invested at the worst time. We have seen a lot of people invested in silver when silver was at 4 lakh, and within I think matter of 3 days, 4 lakh became 2,25,000.
Correct.
40% correction in just 3 or 4 days. I've never seen in equity also. So
Correct.
that kind of volatility, that was nothing but FOMO, where people were desperately investing even when silver moved from, you can say 1 lakh to 4 lakh in just 6 months to 1 year.
Correct. What kind of mistake teaches more, slow and painful or fast and embarrassing?
I think slow and painful mistakes, you can say in a way gives you a much, you can say bigger lessons to learn. See, fast and embarrassing mistake, you always try to ignore that it was a one-off incident. You don't learn anything. You just think that theek hai, ho gaya, one mistake, ignore it. But slow and painful mistakes compound over a period of time, and that hurts you more. And that gives you much, you can say, important lessons. When to cut your losses, when to change your thought process, and never to fall in love with a particular stock or sector. You learn only with that.
When things go wrong, do you analyze immediately or step away first?
Depend on situation to situation, but ideally I'll step back first and then analyze. And then see, it is like, so I'll give you one live example. We launched our business cycle fund in July 2024. And that fund, almost since launch, we have completed now almost 18 months. We have yet to see 10 rupees NAV on that fund. That means that fund is still underperforming the benchmark by 10%. So I will not say that it was a mistake, but something which was not as per our expectation. So we just stepped back and revisited the entire process, that whether we had done some mistake in our backtesting or in selecting some of the factors like momentum heavy portfolio, or whether we are wrong. When we analyzed and we got comfort that this is not something new, it has happened many times earlier also, and recovery also has been equally sharper. So our entire thought process changed, that we are right. Sometimes markets will not be as per the model what we have selected. And if we are convinced, we are okay, we have done our analysis and we are comfortable, we are still going aggressively and pushing that product to our clients. And we have seen the result in February last year, the NAV was almost at 7.5. Now we are up 20%, almost at 9 plus NAV. At peak, our underperformance was almost 13-14%. Now it is less than, you can say, 10%. So all these things gives you that comfort. So if you would have, you can say, just reacted that something has gone wrong, change the strategy, you would have missed the upside also. So because you
Correct.
step back and analyzed and your analysis give you that comfort that you are on the right track, that's why you can survive that, you can say, phase also.
If your working style were a sport, what would it be?
I think as a fund manager, I always feel that our investment style should always be like test match. I don't have to, not only as a fund manager, but even as an investor, it is like a test match. You don't have to play every ball. So as I said, silver at 4 lakh. Okay, those who have made money, they have made money. I don't want to chase silver at 4 lakh just because someone else has made money. So I can leave some of those ball. Then you have to defend some of your tough, you can say, some tough session you have to defend. So that time you have to play that defensive role. So we have seen Trump is there. He's going to do something which is not in your control. So you have to, in a way, change your asset mix, change your asset allocation in such a way that even his policies, even his tantrums will not have a larger impact to your portfolio. And then you have to always keep your mind open that whenever you get opportunity to score, you will be there to score also. So that is where momentum will help you to have a overall. If you want to win matches, it is not one thing or one stock which will help you. It is all about the process. So that's why it is more of test cricket rather than, you can say, T20 or something, some other sports.
And one final one, mutual fund or SIF?
It's never, you can say, either and or. It is always both of them. So like earlier we used to have core portfolio and satellite portfolio. Today I think mutual fund as of now should be your core portfolio. And you can start smaller allocation in SIF. As I said, SIF is just starting. We are just seeing 7 strategies. So in mutual fund, as SEBI kept on adding more and more categories, you will see in second and third phase of SIF also more number of products coming in. So you can go slow, but you should not avoid SIF just thinking that this is not for me. SIF is in a way, if you ask me, SIF is nothing but mini AIF with mutual fund taxation. So much better on flexibility compared to MF and much better on taxation compared to an AIF. So definitely if it continues for next 3 to 5 years, it will be a much larger pie in all your incremental flow. So you have to always keep it open. And as I said, it is never either or. You have to select both.
Yeah, I think so. What you're saying is right. It is a mini AIF with the characteristics of a PMS and the taxation of a mutual fund and the
Yes.
transparency also of a mutual fund.
Yes.
So thank you, Bhavesh. It was a very insightful conversation on SIFs, and we are really glad that you could make it for this session.
Thanks. The pleasure was all for us. Thanks for having us over here. Thank you.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully